Hello everyone and welcome to Finquisitive. In our last video, we talked about mutual funds and tried to explain what are mutual funds in a simplified manner. Please watch the video if you haven't seen it already, because here we try to build up upon it and talk about what are ETFs. So, ETFs are nothing but mutual funds, except that they are traded on a stock exchange. This is where they get their name from: exchange traded funds. Now, what does this mean? It means that just like stocks prices go up and down during any trading day, prices of ETF also go up and down as they are bought and sold throughout the day. Unlike mutual funds, whose price is determined after the trading day has ended. A small explainer about exchanges before we move forward. When a company wants to raise money from public, they have to go through an IPO, which is an initial public offering, simply meaning that they are initially offering the public their company's shares or ownership in exchange for money. When people believe that the company is good and decide to buy shares in exchange of their money, a stock exchange comes into the picture, and this exchange then lists the shares on it, so that the investors and traders are able to view the price performance of these shares. With this, we hope that we explain the terms exchange, traded, and funds properly. So, why are we really talking about ETFs? Didn't we conclude in a previous video that mutual funds sahi hai? Well, mutual funds sahi hai, but there is one thing about mutual funds that really affects the long-term performance of its funds. And truly, it's just this one singular thing, and that is its expenses. To show you, let's take a real-life example. We decided to research upon the different expenses that a Nifty 50 index mutual fund and a Nifty 50 ETF would charge. After going through numerous funds and ETFs, we calculated that an average Nifty 50 index mutual fund charges 0.16% as its expense ratio, whereas a similar ETF charges 0.06% for the same. Now, please remember, this average 0.16% expense ratio of a Nifty 50 index fund is the lowest expense ratio that we will find in the mutual fund industry. Expense ratios only go up from here. Why does it happen? Because index funds are supposed to replicate the indexes like Nifty 50 and not do much. This is why they cannot charge more from the investors. But as other mutual funds exist, whose performance is based on the ability of the mutual fund manager to outperform the market, the more its expense ratio starts to rise. And do you remember what we talked about in our previous videos? According to various studies, the majority of the mutual fund managers are unable to beat the returns of its benchmark index. Example, a large cap mutual fund has the benchmark of Nifty 50 or Nifty 100 that it tries to beat, and a small cap mutual fund has a benchmark of Nifty small cap index that it tries to beat. So, how justifiable are mutual funds' expenses if they are not even able to beat the benchmark index? This is a question that we can all easily answer. Going back to a comparison between a Nifty 50 index mutual fund and a Nifty 50 ETF, both of them had an expense ratio of 0.16% and 0.06% respectively. And this, again, please remember, will be the lowest average expense ratio that you will find for a mutual fund. All of the other mutual funds will have much higher expense ratios. So, what does a difference of 0.10% translate to our investments in the future? We decided to figure this out by taking a few assumptions. We assume that we are investing rupees 10 lakh for 30 years at a rate of return of 12% and taking expense ratios of 0.16% and 0.06% respectively for the index fund and ETF. And we found out that at the end of 30 years, the index fund turned rupees 10 lakh to rupees 3 crore 19 lakh, while the ETF turned it to rupees 3 crore 29 lakh, a difference of rupees 10 lakh. Just imagine that us choosing a similar ETF with a similar return characteristic and a difference of just 0.10% in expenses can save us rupees 10 lakh in the future. And this amount that we save only keeps getting higher and higher since we invest more and more in the future. Why? Because expense is calculated on the basis of how much money we decide to invest in the fund or ETF. An expense ratio of 0.10% on rupees 1 lakh is only rupees 100, but on rupees 1 crore is rupees 10,000. And as you keep getting richer and richer, this difference in expense ratio really starts to hurt your investments. With this, we hope that we were able to explain ETFs and how they have an edge over mutual funds over the long term. We will analyze all types of ETFs in our videos and will get into detail in all of these so that you, our viewers, can take an informed decision about your investments. If you like the video, then please do leave a like and subscribe to the channel. It means a lot. Thank you so much for watching.